So good afternoon to those joining us from India. Good evening to those joining us from Singapore and Japan and other parts of Asia. And good morning to those who are joining us today from Europe. First, a very quick introduction to our firm for those who may not be familiar. Khaitan & Company is amongst the oldest and the largest law firms in India. We have been in service for about 110 years. We are a team of more than 800 lawyers spread across 5 cities in India: Kolkata, Delhi, Mumbai, Bangalore, and Chennai. We have recently opened our first international office in Singapore. We are a full service law firm with specialized practice area groups for practices such as direct tax, indirect tax, antitrust, real estate, intellectual property, data protection, employment, and so on and so forth. Our corporate and disputes resolution practices are our largest practice groups, and we routinely get involved in some of the most complex and noteworthy M&A transactions and disputes in India. To give a quick introduction about our insurance group is a sector-focused group that is part of our corporate practice. Across our offices, we have about 5 partners who spend a vast majority of their time on insurance M&A matters. We regularly advise on some of the largest M&A and private equity investments in the insurance sector. We've also long advocated to the government and our insurance regulator, which is the Insurance Regulatory and Development Authority of India, to fully open the sector for foreign investments and to remove restrictions on ownership and control. We as a firm firmly believe that this reform will add tailwinds to the Indian insurance sector by providing Indian companies the ability to get best-in-class know-how, product innovation, distribution systems, access to wider pool of capital, and so on and so forth. A very quick introduction to my colleagues and co-panelists. All of us on this call here today are part of Khaitan's insurance group. Nikhil is a partner in our corporate group and based in our Delhi office. Arvind is a partner in our Bangalore office. Harsh is a rising star associate and part of our Mumbai office. And I'm part of Khaitan's Singapore and Mumbai offices. So we've all joined from different offices today. So without further ado, let's get the discussion started. At the end of this session, and time permitting, we are happy to take a few questions from those attending this webinar. If you have any questions in the meanwhile, please feel free to post it on the question tab, which is on your screen. So let's get this started. My first question, I'm going to pose to Nikhil. Nikhil, could you give us, may I request you to give us a brief background on the current landscape of the insurance sector in India and how the current regulatory regime has evolved?
Yeah, thank you, Anuj. So the insurance market in India is an exciting one. In contrast to some of the European and the US markets, more mature markets, India still offers a lot of growth. It's vastly underpenetrated as far as all types of insurance are concerned. You can see here some statistics that we have as far as premiums is concerned. India is about 1/6 of China, so you don't even have to go to Western markets to see very clearly how underpenetrated it is. So it does offer a lot of potential. It does offer a lot of growth. There of course have been a number of international insurers in the market in the life insurance sector, but we also see considerable growth in general insurance, in health insurance, and increasingly insurance tech. So it's a very exciting place to be in the insurance world. And we're hopeful that this change in law, the move up in the FDI cap, will facilitate greater foreign investment. There's certainly opportunities here for that.
Do you want us to also, do you want to walk us through the regulatory changes? Because we know that the finance minister, we've been long waiting for this change, and the finance minister had first announced that this sector will be liberalized and opened up for foreign investment in February. From then onwards, a series of changes. And we would like to understand that today, can one say that the law is fully operationalized and foreigners can buy up to 74% in Indian insurers?
Yes, that's right. I mean, just to be clear, the law is now in force, and it is possible for foreign insurers to hold up to 74%. So that's good. And I think the point to emphasize, which this chart shows, is just how quick this change has been. The government first announced the policy change in the budget speech. The finance minister announced it in the budget speech on the 1st of February. And from then until the 19th of August, there has been very rapid progress in rolling the various changes needed to give effect to this out. Just to pick a few key highlights, the first step was the amendment of the Insurance Act, because the FDI cap is baked into that. So that needed to change, and that happened very quickly, which was a good sign, because that involved, amending an act. So it could have actually been the longest one, but that ended up being the first. Thereafter, there were a series of other changes, but the most significant were those on the 30th of July, the withdrawal of the Indian ownership and control, the former regulations there, and most recently on the 19th of August, the notification of the higher cap in the non-debt rules, which have brought these all into effect. So a number of steps needed to happen. But they've happened in a very, very quick time frame, reflecting, I think, the government's intent and resolve to sort of open this up to foreign investment. So that's been very positive. And you can contrast this to the experience in 2015 when, the cap was raised from 26 to 49%, where I think the government, and the IRDA just took a little bit longer to get their arms around the various steps needed to give effect to the change at that stage. Here, they seem to have been much more prepared and rolled this out much more smoothly.
Okay, superb. So what we are taking away, and we get this question asked several times, that is it done yet? And we are able to tell you that it's done. The law is fully operational. Foreigners can go ahead and buy 74% in Indian insurance carriers. Maybe I should pose the next question to Harsh. Harsh, as they say, the devil lies in detail. When we read through all the regulations and all the new circulars, amendments done by the government, anything to be worried about? We know some conditions have been placed for foreigners to be able to own majority stake in Indian insurers, but any devil you found in the details, and you want to walk us through those restrictions?
Yes. So firstly is the introduction of the residency and citizenship requirements on directors and key management persons. Now, all Indian insurance companies having any foreign investment, whether 10%, 49%, or 74%, will need to ensure that a majority of their directors, a majority of the key management persons, and at least one amongst the CEO, MD, or chairperson of the board are resident Indian citizens. Earlier, this requirement was only restricted to the fact that the Indian promoters or the Indian shareholders had to nominate the majority of the board and KMP. That said, this is not an unexpected change, given that a similar requirement was introduced by the IRDAI when the insurance intermediary sector was opened up last year. In addition to this, insurers who have foreign investment exceeding 49% will need to ensure that in case they are paying any dividend and the solvency ratio in that particular financial year falls below 180%, then that insurer will be required to retain at least 50% of its net profit as a part of their general reserves. Additionally, in case the chairperson of a majority foreign owned insurer is not an independent director, then half of the board will need to comprise of independent directors. And in case the chairperson is an independent director, then only 1/3 of the board needs to comprise of independent directors. The IRDI regulations anyway prescribe that any insurer is required to have 1/3 of their board as independent directors. So this requirement wouldn't come as a very onerous one, so to speak.
Any reactions? I mean, were we expecting some of these conditions to come? Do we think that these are very onerous conditions? Is it a show spoiler, or no? We've seen it in other sectors. Nikhil, you want to take that question?
Yeah, sure. Look, I mean, I think this is all net positive. It's net positive in two regards. One is the speed at which this has all been rolled out, which we've touched upon earlier. And as to the substance, you know, when the finance minister first announced the opening up of the sector in her budget speech, there was a reference to appropriate safeguards, and there were questions asked as to what that meant. Would that mean a rehash of the Indian ownership and control guidelines, which frankly would have defeated the whole purpose of raising the FDI cap? And when we see the restrictions, they're nothing like that. You know, the majority, you know, Indian, you know, resident director requirements, if you will, shouldn't be too onerous for international investors to comply with, because the market is now matured, and there is you know, there is ample talent in the Indian market, so it shouldn't be too difficult to hire locally to fill these positions. The main point is that these people will be designates and appointed by you know, the foreign party, which was always the key problem with the earlier regime. So that's changed, and that in itself is a paradigm shift. So that's great. As far as the independent director requirements are concerned, you know, you could argue that this is just good governance. Listed companies are subject to very similar requirements by SEBI in the first place. So I don't think that should cause any discomfort to international investors. And indeed, if you know, if there are joint ventures where you know the parties are looking to list in the longer term, they would have to comply with these in the first place. The only perhaps dampener is the solvency margin requirement, which is perhaps, you know, I'm not sure is really necessary. But again, that's something that perhaps can be addressed in valuation coming in. So, and if you take it in the round with all of the other changes, I think it's still a very positive picture.
Okay, super. So net, we feel that the conditions, the bells and suspenders, if I may say, are not very onerous. The finance minister in our budget speech had said that the change would come with certain conditions, and there are other sectors where these conditions exist. So we don't see these as unsurmountable or something that spoils the party. Now, coming to Arvind, let's ask you the next question. You and I have tried to do several deals, and we always get stuck together. We always get stuck with these Indian owned and controlled guidelines. We get asked by our clients all the time that, look, if the foreign investor is bringing in so much capital, such high shareholding, which until now was 49%, why shouldn't they have some element of control, veto rights, the traditional rights that you have in the shareholders agreement? These, for the benefit of our audience, the Indian owned and controlled guidelines have also been withdrawn last month. What this means is foreigners can now have controlling rights in addition to controlling shareholding in the company. So the question to you, Arvind, is what is going to be the immediate impact of the withdrawal of IOC guidelines? And can a foreign investor seek additional governance rights without moving past 49%? Which is to say, if somebody is today at 49%, already negotiated a set of rights, and he could not in the past get additional rights because of these IOC guidelines, can he now seek additional rights?
Right, Anuj, thank you. So yes, as you rightly mentioned, so far the experience has been that parties would agree to a set of governance mechanisms and affirmative vote items, but often the regulator would have their views emanating out of the Indian ownership and control requirements, and that at times has resulted in parties having to relook the commercial understanding that they had agreed on to make that fit within the contours of Indian ownership and control guidelines. With the IOC guidelines gone, I think the immediate next step is for parties to consider whether they would like to reopen these positions and retain the commercial understanding that was originally reached, given that Indian insurance companies are now permitted to be foreign controlled. Nowhere does it link ownership and control. So the regulations don't specify that only if you're above 51% can you exercise control over insurers. So to that extent, these IOC guideline era requirements should now go away, and foreign partners should be able to relook the governance framework that are currently there in the shareholders agreements and articles of association of insurers. Now, the question is, how would IRDAI view it? So very technically speaking, you don't need IRDAI approval for amending SHAs or articles. IRDAI approval comes in when shareholding exceeding a specific threshold is transferred. So if hypothetically you were to only amend SHAs and articles without changing the shareholding pattern, then in our view, IRDAI approval may not be involved. But of course, that's something that IRDAI will have to express their views on. And even if IRDAI were to consider it, I think a reasonable basis would be that the current conditions applicable to foreign controlled insurers, namely the manner in which board is constituted with independent directors and so on, and solvency control restrictions, those should apply to these foreign controlled insurers. So if a foreigner holds less than 50% and is controlled by virtue of provisions of the SHA, then these conditions should apply. That would be a reasonable basis for the regulator to view such arrangements. Anuj, I think there is something wrong with the audio.
No, I just switched. I unmuted myself. So I was saying that basically lawyers are net losers because of these changes. Every time an investor and a company would shake hands and come to us, and we would tell them, no, you cannot do this because we have something called as Indian owned and controlled guidelines. And there's a bunch of changes that IRDAI doesn't approve. And we would spend a lot of time, if I may say, renegotiating those rights. And what you're saying, Arvind, is now, if there is a commercial alignment, even in existing JVs, you can now, that entire process of going to IRDAI, where IRDAI used to check all your rights with tooth and comb and decide you can have a certain right, you cannot have a certain right, because what constitutes control, all that is gone. In a way, you don't even need to take the agreed suite of rights to IRDAI.
Yes, absolutely, Anuj. That's spot on. Various contentious issues. Business plan is an example. Parties were quite clear that they wanted a business plan. We do, but IRDAI has their views on this. So all of those issues, it should be smoother sailing from now, given where the regulations are.
Okay, super. I think let me ask the next question to Nikhil, because we know these changes will affect in a big way the way M&A deals are done in the insurance sector. What are some of the big changes, Nick, that you expect to happen and the contours of deal making changes to contours of deal making because of these newly introduced changes?
Well, clearly there is a need for foreign insurance. There is a need for capital coming in for a variety of reasons. So this will, I think, spur further M&A activity. On two fronts, there's obviously the possibility of new entrants coming into the market, and they may choose to either partner up with an existing Indian promoter group who doesn't as yet have an insurance venture, or indeed there may be some cycling round of investments within the existing joint ventures with certain parties exiting and new investors coming in. That's one dynamic that could obviously play out. The other is, of course, within the existing joint ventures themselves. It's likely that in a number of cases, the international investors will look to increase their investment to 74%. Now, again, a lot of this depends on the terms of the shareholders agreement, because if they have a put or a call arrangement, as many of them do, then it's obviously a much simpler process. Of course, even there, it may not be all plain sailing, because what we see sometimes is that there are puts or calls which are drafted, but the mechanics of it aren't fully fleshed out. People put these things in, and maybe they were drafted a long time ago without any real hope or expectation that this would happen. And then road testing these is an entirely different matter. So, working through the provisions in terms of giving the notices, the valuations, the timing, etc., that needs to be thought through. A number of the agreements, the agreements will also need to be analyzed in order to determine whether they envisage any change in the governance structure, because it would be inappropriate to move up to 74%, but be stuck with legacy governance arrangements. So those are all some of the issues that need to be thought through. The other point is, of course, on valuations, because that's obviously a key issue and a key commercial point. Now, the insurance sector is robust. There's a lot of growth. So aligning valuation expectations is obviously going to be a key factor beyond the legal considerations, and that will also shape M&A activity.
Superb. You're right. We've seen this valuation interplay, the vast gap when some of these call and put options agreed provisions get exercised. The parties struggle to agree on valuation, and the gaps have been very high, but big. But hopefully we'll get to see some of those mismatch of expectations. Now, let me ask Arvind the next question. Arvind, now that we know that IRDAI used to do a fair bit of scrutiny when approving applications, they are very concerned as a regulator, and rightly so, because at the end of the day, it is about policy holders and they need to be protected, etc. So you need to have credible players in the market. Now, at 49 itself, IRDAI would put each application under the microscope, want to know who's the company. In case of private equity guys, they'd want to get some sense of who the LPs are, etc., etc. Do you imagine that now that 49 has been changed to 74, IRDAI will scrutinize proposals differently? And foreign investors looking at control deals especially should expect much higher degree of scrutiny by the IRDAI.
Sure. So, Anuj, I think the way to look at it is the level of diligence on the promoter of an insurer has fairly been established. Private insurers have been around for close to 3 decades. So, IRDAI has also set its expectations in terms of what it needs to understand about a person promoting an insurer. So, of course, because some of these entities are not domiciled in India, IRDAI may need to do some additional diligence to draw comfort on their situation and fit and proper criteria for running an insurance business in India. But we would expect the process to follow the current checks and systems in place for deciding promoters of insurance companies. So IRDAI's experience so far should hold it in good stead in the current situation. Coming to the question on private equities and how that is likely to be viewed. Now, of course, IRDAI has been quite clear that it wants to do detailed diligence on persons holding shares of Indian insurers, more so when they come in as promoters than mere investors holding less than 10%. So IRDAI has always been keen to understand what is the source of funds and who the investors behind the fund are and so on. In the past, we've seen IRDAI get comfortable around descriptions of who the investors of the fund are and where they're domiciled, and especially in the case of funds of good pedigree, IRDAI has gotten that comfort fairly quickly. We expect that to continue in the 51% reality as well, because a lot of these systems and processes have been fine-tuned based on the experience of last 3 decades, and we expect that to continue with some minor refinements for taking into account geographic differences.
Okay, so basically what you're also suggesting is that we don't anticipate, we continue to believe that IRDAI will scrutinize as carefully the applications as it used to. We don't imagine a paramount shift there, and they'll continue to, in case of private equity funds, they'll want to continue to get some sense of who the LPs are of the fund.
Correct, absolutely.
Let's go to the next question. Let me ask this question to Harsh. Harsh, we know that the concept of Indian promoter, because still until now foreigners could only hold up to 49%, and the concept of Indian promoter was very central to all of IRDAI's legislations, because you needed a robust Indian promoter to be the face of the insurer. Now that IRDAI has permitted 70, and the government of India has permitted 74% holding by foreigners, and we can have insurers for the first time owned by foreign private equities players, sovereign wealth funds and the likes, with a very minority stake being held by one Indian or several Indian groups. Is the concept of Indian promoter relevant any longer?
So the IRDAI usually classifies shareholders holding less than 10% as investors, and shareholders with stakes greater than 10% are classified as promoters. Now, given that the FDI limit is at 74% for foreign investors, you would still need 26% to be held by Indian investors. And as per IRDAI regulations, in aggregate, all Indian investors can hold only up to 25%. So on that technicality, the concept of an Indian promoter is still required. However, this aspect is something that the IRDA may address in the future. The concept of a promoter is to provide financial support. The promoters in charge of solvency ratios, governance, and other responsibilities in relation to the insurer. And if you have a foreign investor holding 74%, then the requirement for an Indian promoter is actually negated. So maybe going forward, this is something that the IRDI will address, but for now, an Indian promoter will still be required.
That's helpful. Now let's go to the next question, because as a firm, we also get the opportunity to represent several private equity investors. And we know that there's been not a level playing field when it comes to other classes of investors, and we have a separate set of guidelines for private equity investors. Let me ask this question to Nikhil. Nikhil, from a perspective of PE folks, is there any change in regulations which need to be considered or which is important to them that they need to note of while doing deals?
Yeah, first, before coming to that, just as an overarching point, I think you make an excellent point, because the insurance sector is very attractive to private equity investors. We've seen private equity investors invest in both listed public companies, insurers, as well as unlisted insurers, and we know that the sector as a whole and the growth potential excites them. And you add that to the deleveraging that the RBI is imposing on the banks and the natural vacuum that exists, and it's quite a good fit in terms of them providing capital. So I think they are a key set of stakeholders and likely to be a key participant in the insurance M&A market. Now, what do the changes mean for them? So I think the main takeaway for them is that there are, of course, multi-layers to the insurance regulatory regime in India. The Indian ownership and control guidelines have now gone away. There are enabling provisions in the FDI policy and the non-debt rules allowing them to invest 74%. And then there are the governance requirements in that regard that we mentioned. So they will have to satisfy those. Now, as an overlay to all of that, but all of those are positive. As an overlay to that, there is a separate set of PE guidelines that the IRDA published a few years ago. Now, that hasn't changed. That regime still remains in force, and in some cases, they may impose incremental requirements. So to pick one example, the PE guidelines do have their own governance requirements. So if you're a PE investor, in addition to the points we've discussed earlier on, you will still have to look at the PE guidelines to see what needs to be satisfied. For example, in this case, from a governance perspective. Now, in the future, we hope that the IRDA will look at this and will take a step back and consider whether certain aspects of the PE guidelines themselves need to change. But that is a separate regime outside of the question of foreign ownership, and that still remains intact. So that's certainly something that private equity investors would need to consider.
Okay. And I think also the point that you make, because they've been so active investors in the insurance market and leave alone the insurtech market, which is a separate creature altogether, and that segment has been buzzing. We've just been seeing deals after deals on the insurtech side, a lot of money being put by financial sponsors there. But there was this dichotomy because Indian private equity could do these control deals earlier, but there's a dichotomy. The foreign private equity folks were not able to do these control deals. So I think this also brings them at the same level playing field. And now foreign private equity folks can also look at doing control deals in India. Let me go to the next question. Arvind, maybe I can ask you this question. We know that several of the insurance JVs in India are promoted by Indian banks, and they have been traditionally the dominant insurers in the industry. Will the change in the FDI limit upset that equation?
So, Anuj, I think there are a variety of factors at play on the role of banks in insurance. as of date, that still continues to be a channel from where a lot of products are sold, and to that extent, that dominance is expected to continue. But RBI has at the same time been pushing to reduce banks' exposure to non-core businesses such as insurance. So that is obviously going to have an effect in terms of banks' ability to continue to maintain a majority shareholding, and they may look to sell down their shareholding. The fact that there are foreign investors now available in the mix to hold a controlling stake would probably mean good things for the banks from a valuation perspective. The other aspect that would be quite interesting to watch is the role that technology will play in insurance distribution, with foreign investors now being able to come into the market with control of insurers. There might be an influx of foreign insurers who are technology driven really coming into the market and really challenging the way in which insurance is distributed in India. So yes, the sector is poised for change, both on account of the role that technology plays on these things under the current situation, and the FDI cap being changed.
Okay, superb. So we feel that this will change some of the traditional models that have existed. Hopefully, as you rightly say, the banks, at least on the life insurance side, have been the dominant. The insurers with a bank partnership have been largely the dominant player, but with maybe sophisticated technology know-how, which can more seamlessly flow into India. Hopefully, some of that will change, and that group will get disrupted a little bit. But let's see where that goes. I think we've maybe I can take a few more questions before we open the floor to the audience and to those attending this webinar. So let me ask you, Nikhil, one more question. Share your thoughts on the current FDI changes and how they compare with the changes from when FDI was liberalized from 26 to 49 for insurance companies.
Look, I think the changes are very positive. They're directionally right in terms of what they're trying to achieve. They're not seeking to impose an extra layer of Indian ownership or control guidelines. So, and I think that's the biggest positive. So it's not sort of, providing a higher cap on the one hand and taking it away through backdoor restrictions on the other hand. The requirement for resident ownership, I think, is just, is something that can easily be addressed. And so I think it isn't hindering anything. It's a big step forward. Also, in comparison, and in the last time around, the IOC guidelines were perceived as a significant stumbling block. So that's one point of comparison. The other, I think, point that's relevant is that the last time around, it took the government and the IRDAI some time to get their arms around all the changes that were needed. It took time to amend the Insurance Act. The IOC guidelines took some time to come out. There were no insurance transfer regulations, and they were promulgated in 2015. So all of that took time, which meant that insurers had to sort of wait around until all of this played out. None of that is the case here. The government and the IRDAI seem to have had a plan. The 2015 transfer regs already exist, so there's no need to do anything there. I mean, they've made the changes that are needed to them. They've amended that, so that's happened. The Insurance Act was amended quickly, and the IOC guidelines were removed. So, everything that needed to be done has been done fairly quickly. So I think these two things are in quite stark contrast to the experience the last time around, and that should give investors a lot of confidence.
Yeah, absolutely. And in fact, if I can add, and I'll ask Harsh to chime in, even look at the changes that were made to intermediaries. Very recently, I think it was last year, when the government allowed changes, the government allowed 100% ownership in intermediaries. Earlier, intermediaries and insurance were clubbed in the same basket. So that umbilical cord was broken and intermediaries were treated differently. But Harsh, you want to walk us through what we understand is restrictions imposed on intermediaries today is at higher pedestrian. And when it comes to insurers, the checks and balances introduced are much simpler. So which again comes as a pleasant surprise to us.
That's would agree with you there, Anuj, because when it comes to intermediaries, the changes that were introduced, the conditions that were applicable on intermediaries with the majority foreign ownership included requiring the IRDI approval every time they wanted to repat dividends, and there were restrictions placed on and thresholds placed on related party transactions that such intermediaries could undertake. So from that perspective, in fact, these conditions were expected to also be imposed on insurers, and these weren't, which was a pleasant surprise. So from that perspective, yes, the regime which has been opened up for insurers now is a lot more liberal, and is something that will excite foreign investors, hopefully.
Super. So I think at least I've exhausted all my questions. Let's see if we can take we still have some time, so we can take some questions from the audience, if there are any. And to the people who are attending this webinar, our email address is there on the screen. It will be a pleasure to answer any question even after the webinar if something crosses your mind. Let's see if there are some questions. Okay, we have the first question, which is, are we likely to see more primary deals or secondary deals given this change in FDI limits? Arvind, you want to take that question?
Sure, thanks, Anuj. So I think again, yes, I think from a regulatory perspective, really there is nothing that there isn't much that separates a primary versus a secondary transaction. But from where the industry is at, I think we would see a good mix of both. On the one hand, you have banks who are looking to downsell given the regulatory pressures that we discussed a while back. So that is probably like, and of course, many Indian promoter groups would like to sort of cash out given that larger foreign investment is now permitted. So they may want to monetize some of that shareholding. That is likely to see a fair bit of secondary transactions. Of course, banker arrangements and how all of that will be woven into a non-controlled situation will be an interesting point to watch. So I guess, yes, all of those are conditions that could drive secondaries, and it will be interesting to see how that pans out. At the same time, there were a lot of insurers who have so far refrained from entering India, largely because they wanted control and regulations did not permit them to have control. So they may now decide to set up greenfield ventures in India. That is likely to see a lot of primary interest. So yes, I think we can expect a fair bit of both, and this is definitely good days for the sector.
Super. Yeah. If I can add my 2 bits, when I'm not a banker, but even my instincts and discussions with some clients says that it is largely to remain a mix of the two. In the immediate term, perhaps we will see a lot of secondary deals because we know a lot of Indian promoters, because of their other businesses in stress, want to monetize their insurance business, but we know that the world is flush with liquidity. There are a lot of people on the side wanting to enter India. So I think even I feel based on my discussions that it is going to be a mix of secondary and primary. First set of deals perhaps would be secondary, but we are going to see a significant more number of deals on the primary side, but time will tell. Let's take a few more questions. We have a question which is, would there be any new format of approval, or does more information need to be provided to the IRDA as part of the application? I think Arvind touched on this question, but why don't I ask you, Harsh, to give your reaction, because we know you've made a number of applications to the IRDA for various clients.
No. So with the new regulations, there's no additional requirements in terms of or any new format as such for information to be provided to the IRDAI. It's just going to be the same information, the same checks for fit and proper. I think Arvind mentioned earlier that we may see a bit more scrutiny when it comes to control deals. But for existing foreign insurers, existing foreign investors who want to increase their stake in their JVs, possibly this could be an easier process given the comfort that the IRDAI would already have with these investors being around for a while. So that should be a rather simpler process. But Anush, to answer your question, no, there is no other format that has been prescribed, or no other additional requirements as such which have been laid out.
Okay. I'm taking another question, which is how long would IRDA now take to approve increase of stake by existing foreign investors? Maybe I should ask this question to Nikhil, but I should also, before Nikhil, we invite you to answer that question. We know that we've struggled to conclude insurance deals because of what we used to love debating, the Indian owned and controlled guidelines. Those guidelines out of the window. Hopefully the timeline to do insurance deals condenses significantly, but why don't I ask you to supplement and answer that question?
Yeah, look, you're right. I mean, a number of things that used to factor into the IRDA's decision ought not to be a consideration now. They ought not to be concerned about the governance arrangements beyond the board composition satisfying what they've set out. So things like affirmative voting rights, reserve matters, that sort of stuff, quorum requirements, shouldn't concern them in the way that it did in the past. So hopefully this will smooth things out. I think it depends on the type of deal. If there are other regulatory issues, I think Arvind has touched on the RBI's focus on deleveraging. We've seen any deals that involve banks consolidating their stake, increasing their stake, that has tended to be problematic, or takes longer with the IRD. We've seen that in a big, in a fairly well publicized deal in the past. But if you, outside of that, in sort of more vanilla situations, if you will, there the hope is that these changes will try to speed things up, because the only thing then that the IRDA needs to look at is the fit and proper requirements and to tick the various other boxes. Now, that said, these things do take longer than we would like, and our clients would like. We've seen them take often a number of months. That may still be the case just because of the IRDA's normal process and the IRDA's internal calendar and the internal requirements. So it will still need to align to that, and it may still take the same length of time for that reason. But we're hopeful that at least some of the process, some of the considerations being simplified may result in a more streamlined process. But we'll have to wait and see over the next year, 18 months or so.
Yeah, no, absolutely. What you say, we all tend to agree with what you say. Maybe the what is within the control of the parties, perhaps that piece I feel may get truncated. The bilateral discussions and negotiating the deal, that becomes much simpler to my mind. But regulator will need to still, perhaps even more, need to be satisfied that, look, if they're allowing somebody to own controlling stake, he's a fit and proper person, and that will entail perhaps weeks of scrutiny, but time will tell. We should take one more. There's another little technical question, but let's see. It says, given the restrictions on insurers and intermediaries being part of the same group, do you see any structuring issues with foreign players wanting to invest both in intermediaries and insurers at the same time? Basically, what I understand the question is there any restriction on insurer to own, on an investor to own stake in an intermediary, insurance intermediary, and to invest in an insurer? Harsh, you want to take that question? I know you've done deals for same clients who invested in intermediaries as well as insurers.
Right. So the IRDAI has its set of requirements. It does permit there to be an intermediary and an insurer within the same group. There are numerous examples right now in the market. What we do see is the IRDAI prescribes certain limits on the amount of business that this intermediary can place with an insurer within the same group. And that is applicable to both the intermediary and the insurer. So as long as those are complied with, and the conflict of interest aspects when it comes to common directors between the intermediary and the the insurer, as long as these aspects are complied with. The IRDAI is very usually sympathetic towards such structuring and permits this quite often.
Yeah. In fact, if I may add, there are instances of same investors owning stakes in multiple insurance companies, and IRDAI says you can have below 10 in as many insurance companies as you like. Of course, you need to go and convince them and persuade them that there won't be conflict of interest. And I understand above 10% you can own as a foreigner today or as an investor today in one life insurance, one general insurance, and one health insurance. Is that correct? Okay.
Yeah.
Okay, so we are going to take this last question, which seems to be a very interesting one. Someone is asking, why did the government stop at 74%? What is your view as a firm? Should the FDI be allowed to up to 100%? So we will allow the firm to take some more time and form a view, but maybe I can ask all the panelists here to share their individual views on what do we think? Should the government have stopped at 74, or should we ask the government? Do we feel that the government should go all in and increase the cap to 100%? Maybe you should all take a stab in this one. Nick, you want to come in first?
Yeah, look, personally, I think it would be a good thing for the cap to be raised to 100%. Having a 26% partner that doesn't really do anything. And ultimately, what really matters are the interests of the policyholders. And I don't think it matters to them who owns the insurers. But as to whether this is likely to happen, I don't know. I think, the government has gone as far as it can. That parallels with, the ownership limits in other sectors, private banks. So I think, although I'd like it to happen, I'm not sure that the government will increase it beyond this, at least not in the short term.
Arvind?
Yeah, I have to agree with Nick. Given that this has just happened and this has been waited for, I think, close to 10 years now, not likely to happen immediately. But yes, I think the parallel that insurance always draws is with banks. Now, for private banks, of course, FDI is capped at 74, but foreign banks are permitted to have branch offices in India or have wholly owned subsidiaries in India to undertake banking businesses. And there are quite a few examples of foreign banks operating in India in that model. From a customer perspective, I think nothing changes. I mean, the way you look at a bank is how you look at an insurer. You want them to be around for 30, 50, 90 years. And with the correct sort of safeguards, you can ensure that. And we've seen the success story on that on the banking front. So I think the government and IRDAI should really look at the success of banking and now start thinking towards an eventual 100% in insurance as well.
Okay. Harsh, you have anything to add?
Yeah, I think we saw the 26 to 49% change take about 5 years, 5.5 years, and I'm hoping that the jump from 74 to 100 is a shorter time frame. Something that I mentioned earlier as well, the requirement now of that Indian promoter holding 26% is not very significant, and maybe in the next couple of years, the IRDAI will and the government will get comfort that foreign insurers are also here to stay for the long term. And with that, possibly permit 100% FDI in the sector, maybe with certain additional conditions. But I'm hoping that this change takes a shorter duration than what the 49 to 74% took.
Yeah, absolutely. And if I can, we all tend to agree. It has taken many years. It's been a very politically sensitive reform. It has taken years from the time it was first introduced to get to 26 to 49. In a way, 26 to 49 doesn't matter much because it's only economics. They took away the ability for foreigner to control. So we did not see, although we saw a flurry of deal activity from 26 to 49, it was largely the same set of insurers and foreigners who stepped up their holding. So it's taken forever. It's a sensitive issue. I think once the regulator gets comfortable, because these are insurance companies by nature, a very long-term play. What I understand from my banker friends, it takes, and from my insurance clients, that it takes 10 years or more for a life insurance company to break even. So, we will need to give some time to the regulator and the government to get comfortable that all is well. And, we know that the policyholder interest is at the center of everything that they do. So hopefully with maybe I also feel comfortable that it should be one step at a time. It's a good thing to happen, and maybe once the regulator gets comfortable and the industry is doing well, then it's the right time to ratchet it up to 100%. Okay, with that, all questions exhausted. Looks like those attending the webinar, they've also exhausted their questions. Like I said, you have email addresses on the screen. Feel free to reach out to any of us. It will be our pleasure to arrange a call with you or to answer your questions. And all that I'd like to say, it's been a pleasure to host you and to conduct this session. We hope you found it informative. Thank you.
Thank you.